You know what's really something? When the best thing you can say about a market is that it wasn't down 1,000 points. Well, it sure may have felt like it. Dow only fell 635 points, and the S&P only lost 6.66%. Oh, that's a great number, 6.66. And the NASDAQ only gave back 6.9%. Only. I love it.
Interest rates, no change in interest rates. The committee today decided to keep the target of the Fed funds rate 0 to 1/4%. The committee currently anticipates that economic conditions, including low rates of resource utilization and subdued outlook for inflation over the medium run, are likely to warrant exceptionally low levels for the Fed funds rate at least through mid-2013.
That's big.
On the economy, the Open Market Committee saying since it last met in June, it indicates economic growth so far this year has been considerably slower than the committee had expected. Indicators suggest a deterioration in overall labor market conditions in recent months, and the unemployment rate has moved up. Household spending has flattened out. Investment in non-residential structures is still weak. The housing sector remains...
What's going on out here?
Hi, this is Chris Wilhelm and welcome to my weekly video blog. Wow, what a crazy 72 hours it's been. This past Saturday, the Standard & Poor's lowered the credit rating for the good old USA from a AAA down to a AA+. On Tuesday, the Dow Jones Industrials got smashed for 634 points, the largest point decrease since October of 2008. In that same afternoon, the Federal Reserve reported that the economy is still showing weak signs, and they're projecting it could take us another 2 years to get out from this recession that we're in, and they see no growth in employment at least until 2013, and they've committed to keep the Fed funds rate, that's what they charge banks to borrow money overnight, between 0 and 1/4%. Wow, that's a lot of data. So let's back up. We already told you that the Dow Jones Industrial lost all those points on Tuesday, so we know they didn't like the report on Saturday. So let's take a look at that report on Saturday. So the G20, which is a group of the 20 finance ministers and central bank governors, which was established in 1999, they monitor economic growth throughout the world, and they kind of report, they kind of share numbers. It's like almost like a big book club, so they can kind of keep track of it. Now, you have the Europeans, and then obviously you have the other ones who operate of a different sovereign. So let's really take a look at the other countries that are not in Europe that really kind of operate off of our sovereign, who have a higher rating than we do. That's the United Kingdom, Canada, and Australia. Those three countries have a AAA rating. We already know that the United States has a AA+ rating. Here's some numbers for you. Those three countries combined have a GDP, which is gross domestic product, of $5 trillion. The United States is $14.7 trillion. That's nearly 3 times the amount of those three countries together. So even though we got downgraded to a AA+, if you had to invest $1, where are you investing your dollar at? I think the answer is pretty clear. But obviously on Tuesday, the market did not like that. Coupled with the Fed's announcement, there was a huge sell-off. So where did that money go? Did it vanish? Does it go away? No. That money shifted out of the stock market into what we refer to as the bond market, to treasury markets, which also includes the mortgage-backed security markets. So bringing this all back together, even though there's some crazy numbers that came out and we've seen a lot of volatility, the true message today here is for you to let your clients know interest rates have plummeted. Especially after Tuesday's numbers as well as into Wednesday, the market has done nothing but drop. And as I speak to you right now, interest rates on a 30-year fixed rate are close to 4%, and they're looking like they might dip into the 3s. Whereas we were concerned on Monday after the downgrading, we might be looking at 5%. So talk about a turn of events. So the true message is to take this data. It's all Greek anyway when you think about it, and there's so many pundits on TV that are talking about it. There were so many politicians last week with all the debt ceiling raising. It's just, and there's so much unrest in the world with all the riots over in London. But more specifically, as to what this video is geared towards, is to keep you abreast of what's happening in the marketplace. These 3 factors I just shared with you have driven interest rates down. And the important message is to let your clients know that, and more importantly is that as volatile as the market has been and as quickly as they've come down, they can go up that quick. So now's the time. We have real estate values which are well below 35% versus the marketplace 2 years ago, which we know is not there, but certainly they have come down that much. And you have interest rates which are almost at 4%. So now's the time. So get the message out. And as always, if you have any questions or comments, please fill out below, and we'll see you guys next week. That took me a little bit longer.